Good morning, everyone. Today is December 5, 2021. We're up today to question number 12 of 20 questions. Today, we're going to discuss the risks and benefits of buying an investment property. As many people may ask, should I buy an investment property or should I not buy an investment property? The answer to that is, first of all, you got to do your due diligence. You have to hire a real professional realtor that's familiar with the area you're looking to buy into and familiarize yourself and study that area very well if it's not an area that you know. First, you would want to look the turnover of tenants over there, how many vacancies are there, so you can take a look at Zillow to see how many apartments are for rent. That's a way you can easily see, or Street Easy, whatever. You can easily see how many properties are available for rent and how long they're sitting on the market before they're rented. That can give you some sort of an idea to know how quick your property would rent out if you were to put it on the market. The other thing is you want to study is what the rental income is, and then you got to do your calculations at what you're looking to buy, what is it going to run you per month, what your net return will be. I'm going to give you, for exemplary figures today, $200,000, so we can easily understand the numbers. Now, one other drawback with investment property as opposed to owner-occupied property is mainly that you need to put down at least 20% in most cases. And all those funds have to be of your own, meaning to say it cannot be gifted to you. You have to come up with those funds yourself. So the bank will ask you for bank statements of at least 2 months. They got to see seasoned assets. They don't want to see large deposits that are not related or has nothing to do with your general income source. So you have to be careful with that. Another drawback is you need even more cash sometimes, because some lenders will require you to have, based on your strength of the credit, sometimes they'll require you to have 6 or 12 months bidding, depends, it's on a case-by-case basis. Sometimes you can get away with that reserves, but basically what the bank wants it for is that you have a cushion in case, let's say you have a vacancy of 3 months or so. They want to make sure you have enough money to cover that gap of those 3 months that you have a vacancy in one of your properties and or apartments. Not necessarily that you're gonna face that situation, hopefully you won't, but the bank finds that risk in an investment property scenario as opposed to an owner-occupied. The other thing is, now, if you're buying an investment property, all the expenses you have, obviously, there are expenses. You have repairs, you have routine maintenance, you have to be burdened with tenants sometimes. However, you can source that out to a management company. They'll do all that work for you. And we call investment property passive income, which means you don't really have to put in labor to get that income. So all you have to do is either you maintain it yourself, that's the work you'll have to put in. Hopefully it's not going to burden you too much. And if you feel burdened, you can hand it out to a management company, an experienced and well-rated management company. They'll take care of all the day-to-day tasks on that investment property. Now, as far as expenses and as far as income, you can depreciate your property. It's generally over a course of 27.5 years. However, consult with your tax advisor to see how you're going to take depreciation expenses and over a course of how many years. They vary from place to place. But I made a calculation based on a 27.5 year depreciation calculation. It came out on a $200,000 property, $7,272. So if you are in a tax bracket where you're paying a lot of taxes, this 7272 gives you a tax advantage, and it's a little bit of a tax shelter. In addition to this, you're taking off obviously the real expenses, which is day-to-day maintenance expenses, insurance, water, electricity, or other utilities, and major expenses like roof repairs, etc. You're taking off the interest expense as well, but those are all real expenses mostly. Now, so you have a capital gain also over years. That's another advantage that you have, meaning to say if you're buying a property of $200,000, typically properties raise in value about 3 to 4% as a conservative approach. So let's say in 10 years, you're going to see a 40% gain. Now, I want to point out to you one thing. When you're doing your mathematics and calculations on your investment return, you're not going to look always at the $200,000. You want to know what your cash and cash return is, meaning if you're putting down $50,000 on a property minus all expenditures you're going to have by rehabilitating the property or day-to-day expenses, you're going to see 10 years down the road, you would want to see what you're making on the $50,000. So the 4% gain we're talking about is on the $200,000, which is, let's say, over a course of 10 years, let's say $40,000. I'm just rounding off numbers to make it more simple. It's more than 40,000 because you have every year 4% on the 4% you made also. But I'm doing it as $40,000. So the $40,000 divided into your $50,000 initial investment is coming out to 80% capital gain. Whereas, let's say if you buy equities like stocks, you're putting down $100,000, you're going to see the $100,000 double. It may have doubled in value, but you put down $100,000, whereas here you're leveraging, you're putting down only $50,000. So that's sometimes the unique feature as well. And then you want to see your cash and cash return on a general basis. You don't want to be left with a negative cash flow on a month-to-month basis. Ideally, I think if you're charging like $4,000 rent on a property, you're spending $3,000 in expenses, you're left with $1,000. That's a nice return. And again, if you want to divide this into $50,000 you're putting in, take the $12,000, it's coming out to about a 20% gain or so. So it's not a bad return overall. I hope you find this information intuitive, and I hope it helps you to make an informed choice when buying and or investing in real estate. Again, it's Jakob Hershkowitz, First Class Funding, MDL Real Estate. Feel free to DM me with any questions you may have. You can contact me as well. 646-339-5358, 646-339-5358. Have a rest of a wonderful day. Bye.